heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Ed Ludlow in San Francisco. Caroline Hyde's off today. This is Bloomberg Technology. Coming up on the program, IBM's $4.6 billion deal for Apptio. We'll speak to the company's chief commercial officer about the acquisition as Big Blue goes on a buying spree, 7 deals this year. Plus, Aston Martin and Lucid strike a deal. Shares of the company surge after the luxury names join forces on the future of electric vehicles. We'll bring you the details, and we get the outlook for tech stocks and crypto with StoneX Group chief strategist Catherine Rooney-Vera. Let's get a state of play when it comes to markets really quickly. We're coming off the biggest weekly decline in technology shares since March, that week where the banking crisis was unplaying. In the session right now, Nasdaq 100 is softer by 0.3%. There's a big focus on the macro, on economics and what central banks around the world will continue to do in the face of inflation. Some outperformance in the US-listed shares of Chinese technology companies. Look at the Golden Dragon, up by 0.8%. We're hovering around 3.7% on the US 10-year yield. There was a move into bonds Thursday, Friday last week at the expense of technology shares, and then Bitcoin holding above $30,000 per token. In terms of single movers, it's all about IBM. It's getting a bit of a boost. We're up kind of a percentage point there or there's about on IBM shares. It's all about a $4.6 billion deal for Apptio, 7th of the year. It kind of fits in with IBM's hybrid cloud strategy. I want to get quick analysis and reaction on this deal from Bloomberg Intelligence senior technology analyst Anurag Rana. Anurag, do you think this is a smart move by IBM? I think we might be having some trouble with Anurag right now. But what we can do is we can pivot and we get the inside scoop on what's happening with this deal. I want to bring in IBM Chief Commercial Officer Rob Thomas. Rob, you kind of heard the preamble there. This is kind of a move that matches what you've done with Red Hat hybrid cloud strategy. But just give us the why on when you went shopping for Apptio.
Yeah, thanks for having me. Great to be with you. CIOs, CEOs, and CFOs are all trying to deal with technology complexity and technology spending. Think of Apptio as a virtual command center to understand your technology spend, your cloud spend, and your labor spend. I would say timing's everything. Is there a better time to have software that can do that type of analysis? I don't think so. Every company is thinking about how do I optimize my spend on technology, reduce complexity. I think this is perfect time for what's happening in the market.
You're taking Apptio from Vista Equity Partners. What role did Robert Smith play in this, Rob? Was he very active in negotiations? And can you give me a sense of how he financially benefits from what is an all-cash deal, right?
Yeah, I think only they can answer the returns question. We've been partners with Apptio for a couple of years. And so this is not a new management team. It's not a new company to us. We've been working with them for a number of years now. They were founded in 2007. And what attracted us to this space is that it's recurring revenues, it's software. These are big focuses for IBM. It's an attractive growth rate. It has all the attributes that we look for in a deal. And because we were users of the product and because we've been partners, we've got a pretty good idea of what it could do, which is what made this the right time.
Rob, what does the deal tell us about strategy going forward? 7th deal. There's a lot of emphasis on the kind of buying spree. Will you continue to be active in M&A?
We are always active and open-minded about M&A. Like you say, it's the 7th deal of the year, mix of consulting and software. And we're always looking for how to accelerate our strategy around how hybrid cloud and AI. As you may be aware, in May, we announced our generative AI platform, Watson X. So we're thinking about what are capabilities that we could bring into that. Another thing that was interesting about Apptio is they collect data that represents $450 billion of IT spend. We think that is very unique in terms of how we can then help clients together to optimize and manage their spend.
We're kind of calling this M&A Monday. There are some other deals out there as well, but it's been quiet, in tech at least. 2023 so far. Do you see yourselves as being opportunistic, therefore, in that sense, taking advantage of kind of the lack of activity out there?
I think you always have to be patient and you have to run a disciplined process. To your point, if you look at the market over the last couple of years, we've gone through adjustments around interest rates. So for a time, it was hard to figure out deals that would make sense as we look at our financial model and what we want to do. But we're open-minded that will start to change. And this is a good example where we saw the right equation for a deal. But we'll continue to look really in the areas that we're focused on: hybrid cloud, automation, data, cybersecurity, sustainability. These are the areas that we're investing in aggressively.
Of those, which is the priority? You know, a lot of emphasis right now in the field of artificial intelligence, generative AI as well. Do you see yourselves prioritizing that?
I think it's hard to pick one priority because if you link it back to Apptio, this is about our thesis around automation, which started nearly 2 years ago, where we've done deals around robotic process automation. We've done deals around AI operations. This is kind of the third piece to the puzzle. So I wouldn't pick one or the other, but certainly there's a lot happening in generative AI. Watson X is about data. It's about building models. It's about models from IBM. It's about AI governance. So I would say all of those are potential spaces where today we're aggressively building, but we would also look to partner potentially.
The final one on the markets. Is there an advantage in going out into the private markets and doing deals with private business versus looking at some of the publicly traded peers of an Apptio?
It's really not part of our criteria when we're looking at deals. We're looking more at strategic fit. What's the synergy as part of IBM? Where the ownership resides, it really is not anywhere in our criteria because those are always just things you'll have to work through regardless of where a company sits.
Rob, in this AI boom, there's going to be increased demand on the data center and compute side. What are you seeing there in the context of IBM, in what terms of your need going forward as well?
I would say what's interesting, what's happening in compute, it's probably perfect for the strategy we set down 3 years ago, which is hybrid cloud. Because with hybrid cloud, you can run your applications, you can manage your data, and you can do that across any cloud. So now clients with a hybrid strategy, which I think is almost every client now, they can choose the right price and right performance depending on what they want to do. If you're in just one cloud, you don't really have that flexibility. So you have to deal with increasing compute costs, something like that. We think hybrid cloud is actually perfect for this moment because you can optimize your spend and the economics around how you deploy technology.
And yourselves, in terms of capacity planning from the data center perspective, how active are you being?
We're always thinking about what is coming next, but I would say it's beyond the data center. We announced with General Motors earlier this year work that we're doing around Linux on vehicles. So think of that as edge computing. So I don't think it's just about data centers. It's about compute can happen anywhere from edge to public cloud to private cloud. We're looking to deploy capital smartly across any of those.
I think the street really likes this Apptio deal. You know, a lot being complementary of how it fits in with your existing hybrid cloud strategy. But if there's one takeaway you want to leave investors with and why we care about Apptio, what is it? What is it that you are sort of most excited about to get this deal closed on?
Every client is trying to put more technology to work for their business. And there's this old rule of thumb that says maybe 80% is about keeping the lights on, 20% for innovation. With Apptio and IBM, I think we can change that to free up more dollars for innovation. And that will be just the start of creating more investments for hybrid cloud, for AI. So this is really about unleashing innovation ultimately.
IBM Chief Commercial Officer Rob Thomas, thank you so much for your time on that $4.6 billion deal.
Thank you.
So, coming up, UK luxury car maker Aston Martin teaming up with its Saudi-backed EV peer Lucid next on why the deal is being heralded as a game changer as both companies aim to steer away from financial woes. This is Bloomberg. Aston Martin banking on a new partnership with luxury electric car maker Lucid to help lead its growth in the EV market. Lucid will receive more than $230 million in stock and cash in exchange for its battery components and other parts. Joining us to break things down, Bloomberg's Sean O'Kane, who covers all things EV and auto for us out in Austin, Texas. I guess the best place to start, Sean, is what does Aston Martin get out of this?
They get a clearer path to making an actual EV. This is something Aston Martin's been at for a long time. You go back more than half a decade, they had actually partnered up with a Chinese technology company, Leeco, whose founder was making electric vehicles at the time. And that project sort of went nowhere. They almost got to the point of releasing that car, the Rapide E, and then shelved it basically after Lawrence Stroll came in. And they've been kind of stumbling around ever since as he's been trying to right the ship there and raise money to move them into this new world. So this gives them really just a better view of something and honestly access to what is thought of as some of the sort of better powertrain components in an EV right now.
Right. You know, Lucid, you and I have covered this company for a long time now, and Lucid's always leaned into the idea that they are a technology leader, right? The energy density of the pack. And yet, you know, Lucid can't get its own house in order from a production perspective. I guess for Lucid, what do they get out of it? They become a supplier of parts.
Yeah, this is something of a return to form to them. I mean, remember, this is a company that was founded something like 15 years ago as a battery manufacturer and, ostensibly with the goal of becoming a supplier as a Tiva. And they were, it took them a long time before they actually decided to go out and try to make their own car and come up with this Lucid brand. And that has obviously sort of flipped things around and sort of eaten that original goal to some respects. But now they're back in that role. And it's something that they have talked about for a while. I mean, when they were trying to raise money, when they were still private, they were in talks with just about everybody. They almost partnered up with Ford at one point. So this is something that I think has been a long time coming for them.
Sean, hold that thought. President Biden speaking at the White House on the topic of Russia. Listening.
So convened our key allies on a Zoom call to make sure we're all on the same page. It's critical that we're coordinated in our response and coordinated in what we to anticipate. They agreed with me that we had to make sure we gave Putin no excuse. Let me emphasize, we gave Putin no excuse to blame this on the West or to blame this on NATO. We made clear that we were not involved. We had nothing to do with it. This was part of a struggle within the Russian system. I also talked at length with President Zelensky of Ukraine. I'll be keeping in contact with him. I may be speaking to him later today, early tomorrow morning, to make sure we continue to remain on the same page. I told him that no matter what happened in Russia, let me say it again, no matter what happened in Russia, we, the United States, would continue to support Ukraine's defense and its sovereignty and its territorial integrity. He and I agreed to follow up and stay in constant contact. I'm also in constant contact with our allies to maintain our coordination. I'll be speaking with the head of state right after this meeting today and making sure we're on the same page. I didn't get a chance to speak with one head of state yesterday. We're going to keep assessing the fallout of this weekend's events and the implications for Russia and Ukraine. But it's still too early to reach a definitive conclusion about where this is going. The ultimate outcome of all this remains to be seen. But no matter what comes next, I will keep making sure that our allies and our partners are closely aligned in how we are reading and responding to the situation. It's important we stay completely coordinated. And now I'd like to turn to today's announcement, begin by asking a question. Did you lay all that cable? She's a Wonder Woman. I was watching in the other room.
President Biden there speaking at the White House, addressing the weekend's events in Russia, where a group of mercenary forces marched essentially on Moscow. The president saying that the U.S. is prepared for a range of scenarios when it comes to Russia. He has made it clear to the Russians that the U.S. was not involved in the weekend's events and not involved in the situation in Russia. But he has spoken with President Zelensky of the Ukraine, and the U.S. will continue to support Ukraine. Biden said that the outcome of the events in Russia remain to be seen. He didn't give a sort of hypothesis of what might happen, and they are continuing, of course, to assess what's happening. We will continue to track that story here on Bloomberg Television all day long. Now, coming up, Japan's government unveiled a $6 billion deal to buy out and take direct control of the world leader in chip making. This is Bloomberg. Time for talking tech. First up, education technology firm Baiju's begun damage control after losing its auditor and 3 board members in a week. Its billionaire founder reached out to investors to assure them that the Indian startup will finally release long-delayed financials and strengthen its accounting processes. And Japan's government unveiled a $6.3 billion deal to buy out and privatize JSR, taking direct control of the world leader in chip making. The move could help Tokyo expand its power over compounds essential for making advanced semiconductors like those in missile control systems and Apple's iPhones. Plus, JD.com aims to create what it calls an innovative retail division for groceries. China's number 2 e-commerce company plans to partner with 7 Fresh supermarket chain and group buying platform Pinpin to deliver food to millions and rival similar business models like Alibaba. And speaking of Alibaba, the company planning to seek approval of its own grocery arm spin-off for listing from the Hong Kong Stock Exchange in 2 weeks. This according to Hong Kong's Economic Times. Bloomberg's Isabel Lee in New York with the latest. Tell me about this spin-off move.
Hi, Ted. Hi, Ed. I'm sorry.
Ted,
I knew
fine.
you were Ed. We're good friends. So this has been the subject of talks for a while now, ever since the historic shakeup that Alibaba has gone through when it said that its big conglomerate will split into 6 baby babas. It was announced earlier this year. So this is among the first in the pipeline. So many were expecting it to be toward the end of this year, and it might just come into fruition. So it will list as early as 2 weeks, which is July or August, and it will go public in November. So apart from this grocery spinoff, we also have the logistics arm of Alibaba, Tainiao. So that's also looking to go public next year if things go as planned.
Ted, Ed, you've been watching Ted Lasso. I know you have. It's okay. I'm not worried about being mistaken for Ted. Let's go back to the story we started on, JD, making a kind of obvious move, right, to take on Alibaba. What's the latest there?
So that is interesting. So JD had a big meeting last week, and recently it said that it will create an independent arm. It will merge its 7 Fresh, which is its grocery retail store, with other units to create something like the innovation retail that you said. So I don't want to say it's meant to compete with Alibaba's grocery spin-off, but it does kind of look like that, because to Alibaba, it's kind of, a lot of people compare it to Sam's Club because it's interesting. It has dine-in, it has delivery, and it has grocery all in one. And maybe that's what JD.com is looking to do as well, especially because last year China's growth really didn't pan out as people as expected. So maybe they're banking on this year with this new thing. They had a big meeting last week where they announced that it will create 7 listed firms with market values of at least $14 billion. And this is probably one of them, Ed.
I just was looking at the Nasdaq Golden Dragon China Index earlier, and there was outperformance. You know, a lot of news flow related to the US-listed shares of China tech. You know, Alibaba, JD, I think there is a lot of focus on the health of Chinese tech right now. In Alibaba's case, what's the big one we're waiting on? You know, this restructuring, we had the management changes. What is it that investors are most focused on?
I think they're just really curious about how this will pan out because, again, this is Alibaba. It's the first in China to do this ever since the intense crackdown we've seen from the government, where they were getting angry at monopolies, saying that they're being reckless and all that. So Alibaba's big move was widely seen as kind of a response to the government. It's hard to imagine that this happened just on their own, especially with the disappearance of Jack Ma. So likely this is with the blessing of the government. So that's what a lot of investors are looking for in China and outside. How will this play out? It's historic, and maybe this will be the blueprint for other companies. Can JD follow it? Can other big rivals of Alibaba probably follow it? Because this 6 baby babas, it's a lot of people were saying it may be good because it will make more nimble companies. They will have each a CEO, board of directors, and probably increase share value. Who knows? The 6 baby babas might even be bigger than the big Alibaba. As we know, big companies can move a bit slower. So that's really what people are looking out for, how this will play out down the line.
Bloomberg News, Isabel Lee out in New York. Thank you so much. Right, coming up, we're going to turn our attention to the markets and get the view from Catherine Rooney-Vera of StoneX Group and her outlook for tech and crypto. I'm taking a quick look at shares as well of Palantir. This is the focus of the Tech Watch column this Monday morning. We're softer by 0.3%. So much hype around AI, but they point out that if you look at the consensus recommendation, that's the proxy ratio of hold, buy and sell, we're at a 2.41 out of 5, and that's the lowest among all the software names on the Russell 1000 software subsector index. Also Tesla, off by 5 percentage points. Goldman, the latest name to downgrade the stock to neutral from buy, citing the run-up in shares. We're up more than 100% year to date, but also declining average selling prices for EVs. That's the fourth analyst, to my mind, that we've tracked in the last week, downgrading the stock. I think Morgan Stanley among those as well, DZ, and also Barclays. One stock to watch. This is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Ed Ludlow in San Francisco. I want to get a quick check on the markets. We've sort of seen declines accelerate, particularly on the NASDAQ 100, where we're now softer by a percentage point at session lows. The story is that we're coming off the worst week for markets since March. And there's a lot of focus right now on the macro picture, what the Fed will or won't do in terms of moving towards rate cutting and the reevaluation on the timing of that. That impacts the tech sector. Higher rates discount the present value of future cash flows. That's the story, and it has been for a really long time. Some outperformance in semiconductor stocks. The Philadelphia Semiconductor Index, or SOX, up 0.8 or 0.7%, and the US 10-year yield holding at around 3.7%. Bitcoin still above $30,000. Remember the story Friday, hitting its highest level in 1 year. There are two movers to the downside that we're paying attention to. The first being Tesla. Its declines also really accelerating beyond 5% now. Goldman downgrading the stock to neutral from buy. The recent run-up in the shares, we're up more than 100% year to date, but also looking at other factors like the declining price of EVs. Mark Delaney moving, probably the fourth analyst in about a week, to downgrade that stock. And Alphabet also downgraded at UBS to neutral from buy. Near-term monetization risks. In the medium term, talking about this pivot to generative AI in the context of search and what that will do in terms of impacting ad inventories. That's all to say that we should zoom out and get more markets analysis and welcome Catherine Rooney-Vera, Chief Market Strategist at StoneX Group. What happened last week, right? You look at the NASDAQ 100. We have the biggest weekly decline since March, the week where the banking crisis kind of unfolded. Bitcoin hits a one-year high Friday. What was driving both of those things?
Well, all signs point to the Federal Reserve driving most of the market action and the expectation of additional rate hikes being discounted after, previous to that, the market had wholeheartedly embraced the idea of rate cuts being the next step for the Federal Reserve. The dot plot shows that the Fed is expecting 2 more hikes at 25 basis points each. But even today, Ed, the markets are not believing the Fed and expecting 1 rate hike. This week, I think economic data are going to be clutch in terms of market movement going forward, whether the economic data from, for example, initial jobless claims, core PCE, the supercore index, all of that coming out this week, indicating whether or not the market is right or the Fed has got it right. So I think that's where the markets are focused, especially as you highlighted on the technical or the technology sector, which has been the foremost front runner of this rally that we've seen year to date.
Catherine, what does the Fed need to see in that data to move from hiking to pausing to eventually cutting rates?
There has to be irrefutable evidence that the labor market is rolling over. There has to be a clear trend, not just this data dependency focused on 1 or 2 months, a clear trend with regard to the super core, which is what the Fed most looks at, ex-shelter, of course, which seems like it's going to start a trend lower. But there really has to be trends with regard to getting to the 2% core PCE target. This is a Fed that has grappled with credibility. Remember the fiasco with regard to transitory inflation, overrunning the easing policy for I think, went long in the tooth by about a year. So I think the markets could be disappointed, Ed, with regard to the Fed's propensity to prop up economic growth versus inflation. I think this is a Fed that really needs to claw back some inflation-fighting credibility, and more likely than not will hike or hold rates at a terminal rate I estimate of 525, but more likely 550 for an extended period of time, longer than what the market is currently discounting. That in itself is negative for stocks, negative for cyclicals, negative for interest rate sensitive sectors, which technology certainly is.
On that note, we're showing the NASDAQ 100 year-to-date performance up 35% or so. A big part of that story was just a few single names, and it was all AI related. So when you look at the breadth of the market, how do you see investors offsetting that AI hype driving us to the upside and then the Fed risk to the downside?
Well, in the short term, if you believe that the market has further upside, which it certainly could if we get very good inflation data showing that the Fed maybe doesn't have to go so long or so much higher for longer, then you could get additional upside. And if you want to play that trade, Ed, I think that you would want to look at the laggards. So you see this divergence between the NASDAQ and small caps. Then you could play the laggards, such as small caps, financials, or energy. My perspective over the course of the next 6 to 12 months, however, is that we should be disproportionately overweighted on defensive sectors, which have not seen a significant run-up year to date. That has been, of course, in favor of technology, and as you mentioned, this very narrow breadth of the S&P 500's recent surge. So I would say look at defensives in U.S. equities, and specifically look in rates. I mean, you could look at the 2s, 10s, steepener play in the Treasury curve, hold a position in gold, in cash. I mean, even Bloomberg had this beautiful chart you guys put out where it showed that high-grade bonds, earnings yield, and 3-month T-bill are all pretty much within a range of 20 to 30 basis points. So I think the risk-reward favors being defensive over chasing the market.
Another beautiful chart that we've been looking at recently is near-term Bitcoin. What happened on Friday? What is the driver behind Bitcoin right now? I think a lot of people put emphasis, right, a lot of people put emphasis on the BlackRock filing. June 15th, that happened. Others point to sort of longer-term indicators around, well, all the chaos is out the way now. We can all move on with our lives. But for you, what is driving that risk asset? I think we may have some technical issues with Catherine Rooney-Vera. It's a M&A Monday. It is a Mayhem Monday. But we thank you for your time, StoneX Chief Strategist. Interesting conversation in the markets. Coming up, we're going to talk about, guess what? Generative AI's impact, but on the retail space. We're going to go from the public markets to the private markets to talk with M13 partner Lizzie Francis. All things VC in our VC Spotlight. That is next. This is Bloomberg. back to that M&A Monday vibe. Databricks has agreed to buy generative AI platform Mosaic ML for about $1.3 billion. The company said in a statement today that it struck the deal with the goal of making generative AI accessible to all organizations so they can build with their own tools and their own data. The acquisition expected to close July 31st. Let's dive deeper into AI, how it's playing out in the VC space and in the context of the consumer. Lizzie Francis, partner and head of operations at M13, has $900 million or so in assets under management. So, Lizzie, everything is at the intersection of everything else. But for you, how do you see the world, tech, consumer, and now generative AI?
Good morning, Ed. Thank you so much for having me on today. Yeah, it's just an incredibly exciting time for innovation across the board with AI, but there's no sector that is more ready or ripe for transformation than retail. And I think what we're seeing is that in the last decade or so, commerce has had an unbelievable tailwind at its back, and particularly the adoption of digital for consumers post-COVID moving online means that brands and retailers have to meet consumers in multiple places now. And consumers are expecting a great experience. And so what that means is AI can actually impact that in two really critical ways. The first is it can improve productivity in very rote ways for very complicated retail businesses. And on the consumer side, it can actually delight consumers by allowing brands and retailers to think about ways that they can better personalize consumer experience and create exciting ways for consumers to remove pain points for them, but also display and show products and services in ways that they have not seen before. And again, all of that is powered by AI, and we're seeing really rapid transformation happening this year.
So when you think about potential portfolio companies that you're investing in the context of consumer-facing companies or their technology, are you looking to them to be sort of AI adjacent or AI native companies?
Yeah, it's a great point, Ed. We're looking at both. And I think what you'll find is that there are companies being born that are powered by AI, and then there's companies that are really leveraging AI for the application layer. So the way that we're thinking about the future of commerce at M13 and what we're keenly interested in when it comes to investing is where will that transformation occur over the next 10 years, and how can it have a deep impact on the consumer? And so, for instance, we've just recently invested in a company called Pietra, which is a really fantastic one-stop shop for entrepreneurs and founders to both ideate new brands and products and then bring them to market rapidly. They're entirely powered by AI. And so what used to be a very long and cumbersome process to launch new products or brands now just takes a matter of days, right? In retail, those of us who've been in it know, oftentimes, even internally, when you're launching new lines of products, that can take up for a year to both ideate, then source, and QA, and test. Now imagine all of that happening within days. So, Ed, you could this weekend sign up on Pietra. Perhaps you want to launch a new mustache grooming brand. And within days, you could have both a fantastic brand, a new design, you could source products and bring it all to market in days. These are the types of businesses powered by AI that are really where we're interested in investing. You also have the application layer. So imagine Rebuy or Max Retail, two of our portfolio companies that are leveraging AI in very interesting ways. Rebuy is creating a more personalized experience for consumers when they shop. So imagine for consumers, now when they go shop at a brand or a retailer, they could have a totally new store or new experience every day that is personalized for them based on these large data sets that retailers and brands can crunch in real time, leveraging AI in ways that they could not before.
You know, Lizzie, we talk on this show, Bloomberg Technology, every day about the energy that AI has given all kinds of subsectors. How has it impacted valuations in the consumer tech space? What are you seeing?
Yeah, it's really interesting what we're seeing. So obviously this is not 2020 or 2021 anymore, but we are seeing that pricing for AI, even at the earlier stage, is higher than it would be in other sectors, or I should say companies that are powered by AI or are AI driven. And you can see that even in unicorns for this year, the last 5 unicorns, 3 of them are AI. And then obviously today's been quite a day for M&A, right, when it comes to AI in the markets. So both at the very early stage and later stage, we're starting to see some really healthy and rich pricing for AI-driven companies. Now, having said that, I think it's a really important moment in time for us to realize that much like the adoption of commerce online or mobile or cloud, this is one of those moments in the market where we will see a really rapid pace of innovation in this particular sector. And even though the pricing is rich, this is one of those moments when great companies are born. And this is what we love to do, invest at M13, invest in the very early stage of companies being born during interesting moments that will transform lives over the next decade or more. So 1999, rich pricing, Google, PayPal, eBay, these are transformative brands and businesses that have driven tremendous value. So I think that we'll continue to see this throughout the year, and exciting to see, again, the rapid rate at which these businesses are being born.
What we've tried to do here on Bloomberg Technology in our Venture Spotlight is ask where the innovation's happening and where the checks are getting written. You're coming to us from Los Angeles. We associate LA with maybe the entertainment industry, TMT, and startup innovation in the gaming space. Is it more than that?
Oh, LA is just a wonderful ecosystem for entrepreneurs, and M13 is really happy and privileged to have our headquarters here in LA. There's deep roots in the community here on the tech side. Over the last 20 years of entrepreneurs and founders that have started great businesses. It's a very close-knit community. And one of the things we love, and an inclusive community, one of the things I love that we've seen over the last decade is we're producing more engineers that are graduating out of our universities. We're seeing that people love to be in a community that supports and nurtures each other at this very earliest stages. And so I think what you'll find is that this convergence of community and technology and venture dollars flowing into the very earliest stages with a diverse and interesting group of founders across commerce, to your point, ed media, technology. We will see many new brands being born here and many great new businesses to invest in.
When we cover consumer tech and the program, there's often an association with celebrity endorsement, from a VC perspective or just a product perspective. Is that something that you're encountering as well?
I think there's always a great story to be told. And I think, yes, and LA lends itself to incredible celebrities who can share and amplify that story. And you're starting to see now that you didn't see 20 years ago, that people realize they can quickly move to market if they have a passion or conviction around a particular area. Obviously, like Honest Company or other folks that have celebrity spokespeople, if you're really passionate about something, why not amplify and use your voice? We have an incredible portfolio company at M13 called LifeForce, which has Tony Robbins behind it. And, being able to leverage Tony's community as well and amplify the message and value proposition of LifeForce, that's an unbelievable opportunity. So again, I think all of these things make sense, and we'll continue to see this scale and evolve over time.
Lizzie Francis, partner and head of ops at M13, coming to us from Los Angeles. We don't do that as often on Venture Spotlight. Interesting conversation about the startup ecosystem there. Thank you so much for your time.
Thank you.
All right, from consumer tech to rockets, coming up, why SpaceX has made over 1,000 changes to Starship. We'll have all the details next. This is Bloomberg.
There are really a tremendous number of changes between the last Starship flight and this one. Well over 1,000. So I think the probability of this next flight working is, getting to orbit is much higher than the last one. Maybe it's like 60%.
So that was Elon Musk speaking over the weekend on a Twitter Spaces with Bloomberg's Ashley Vance, saying SpaceX has a much better chance now after making over 1,000 changes to Starship. Let's bring in Bloomberg's Lauren Grush, space reporter. What a way to spend a Saturday morning. But what did we learn about these changes that SpaceX has made to Starship?
Right. So Elon highlighted a few of those changes. Perhaps the biggest one that he talked about was that the SpaceX is going to implement something called hot staging. So for non-rocket enthusiasts out there, if you watched the last Starship launch, they had a bit of a problem with the staging. That's when the Starship, the top of the vehicle, separates from the super heavy booster. It did not separate as planned during that flight, and the vehicle started twirling out of control. So in moving forward, they're going to introduce something known as hot staging, which sounds kind of interesting. Basically, the engines on the Starship spacecraft, which you can see in that video there on the top, they're going to ignite while the super heavy booster is still attached. And so it's something that Russians have done with their vehicles before, but it just means they're going to have to take some extra precautions to make sure that the top of that super heavy booster doesn't get scorched by those engines. So that was probably one of the biggest things that we learned. Elon also detailed some updates to the engines that they made. If you remember, plenty of those engines on the bottom of the booster did flame out during the launch. So hopefully that will prevent that from happening in the future.
Kind of in case you missed it, but we reported Friday afternoon, myself and colleagues Gillian Tan and Katie Roof, that SpaceX is doing a tender, basically selling employee shares or offering them, valuing SpaceX at $150 billion. You know, the valuation keeps going up. But what was interesting that we reported, Lauren, was the cash on the balance sheet, about $5 billion. Private company, you get a sense of its financial health. But on the spaces after that, Musk did talk about how much they're spending on the Starship program. What did he say?
Right. He said that so far they've invested about $2 billion, and he expects that to approach $3 billion this year. And it's no surprise. It's probably, it is the most complicated program that SpaceX has implemented to date. So I would expect that number to continue to go up.
I guess what's the roadmap from here? Musk always misses his own self-imposed deadlines and timelines.
Yeah.
But what do we know about the roadmap for more Starship launches?
So I think he very much loves the number 6. I don't know if you've noticed, but each time he gives an update, it's 6 weeks away. So it was no different during the spaces. He said that the pad upgrades that they'll be doing to Starbase, if you remember when they did launch, they caused quite a bit of damage to the surrounding area and to their own launch pad when they launched. But they're doing a bunch of pad upgrades. He said he expects those to be done in approximately 6 weeks. But just to remind you that he has said 6 weeks before. In fact, right after Starship launched the first time, he said they'd be launching again in 4 to 6 weeks. So
whether it's 6 weeks. Whether it's 6 weeks notice or 6 minutes notice, Lauren Grush, I know I can always call on you for all things SpaceX. Absolutely. Bloomberg's Lauren Grush out of Texas there. Thank you so much. That does it for this edition of Bloomberg Technology. Don't forget to recap what has been an M&A focused Monday. We have our podcast wherever you get your podcast, but it is on Apple, Spotify, iHeart, and of course on all of the Bloomberg apps and Bloomberg.com. We're one day into what's going to be a big week for the technology sector. When we think about the markets, we're coming off the biggest drop for the NASDAQ 100 on a weekly basis since March. We're thinking about the Fed, but there is some green shoots and there is some energy in the private markets. We're seeing M&A. But what happens with venture capital? We're going to continue that conversation, a big one coming tomorrow as well. You don't want to miss it. This is Bloomberg Technology.